Good morning. Welcome to Flaya's Artificial Intelligence, Blockchain, and Cryptocurrency Forum, what we call ABC. We'd like to thank our sustaining members nationwide, Preqin, Boomerang Capital, S&P Global Market Intelligence, Safe Harbor Equity, Harvest Volatility Management, Millennium Trust, Apex One Investment Partners, Intrust Global, Sunshine Properties Trust, and Sherman Asset Management. We'd also like to thank today's event sponsors, Off the Chain Capital, Grayscale, and BlockFi for making this event possible. Also, we'd like to thank our Flyer board members and the Flyer board for their support during these challenging times. Flyer is a 501c6 nonprofit organization started in 2007 with the goal to become the world's leading marketplace for alternative investments and alternative investment education. Since then, Flyer has helped thousands of firms in the capital raising process, aided in the allocation of billions to alternative investments, and we've leveraged technology to accelerate the due diligence process. Today, Flyer as an organization has over 8,000 members with $5 trillion in discretionary AUM. Thank you for attending today. Our first speaker is Brian Estes, founder and CIO of Off the Chain Capital. Brian?
Hi, thank you, Rainford. Like I said, I'm Brian Estes. I'm the managing partner and CIO of Off the Chain Capital. Off the Chain is the number one performing blockchain investment fund over the past 2 years. And what we're going to go through is just a 30-minute class about why Bitcoin has value and why would you add this to your asset, to a diversified portfolio. Before we begin, I'd like to just have everyone open their mind a little bit. Blockchain assets like Bitcoin are different creatures. They're something brand new that was just invented about 12 years ago. And so you have to think about these differently. You can't value blockchain assets like Bitcoin on a PE ratio, price to cash flow. You can't use credit analysis on Bitcoin. You have to think differently. These are networks, and you value networks differently than you value like stocks, bonds, and real estate. So just for the next 30 minutes or so, I just want to ask you that you open your mind up and think differently about this asset class. So what we're going to go through is a little brief history of money. Bitcoin is an innovation. Why does Bitcoin have value? Why add Bitcoin to a diversified portfolio? We have a few models that we use to determine Bitcoin's value, and then a few ways to gain exposure. When I go through this presentation, I've been doing this for about a year now. At the end of the presentation, sometimes I hear comments like, oh, Brian's a little crazy or he's nuts, because one of the models that we use shows that Bitcoin's gonna be worth $10 million per Bitcoin by year 2029. And so I just want to go through some of the reasons, like I'm not some Bitcoin nut job out there. I come from traditional education. I got my BA from University of Illinois in economics and finance. Did my study abroad at Cambridge University and London School of Economics. And I graduated with high honors from Washington University with my MBA. I come from traditional finance. I spent my first 22 years in traditional finance as an institutional equity broker. And I'm also a patent holder with some software patents, instrument rated pilot. So I'm just some normal guy out there. And then over the past 7 years, I learned about Bitcoin in 2013. When I first learned about it, I thought it was a scam. I thought it was some, pump and dump scheme used for nefarious activities. It took me about a year to actually figure out what it was. When I figured out what Bitcoin really was in 2014, I decided to go all in, sold my practice, and became a venture capitalist in the blockchain space back in 2014. Over the last 7 years, I've helped build, finance, and mentor 4 blockchain companies that are worth over $75 billion today. So a little brief history of money. About 10,000 years ago, humans, we lived in tribes. We lived in tribes of like 100 to 150 people. And what we used as our money 10,000 years ago was the scarce resource or the scarce asset that was in our local community. So for some communities, it was shells. For others, it was stones or salt. For the Indians, it was wampum. And so, we used whatever the scarce resource was as our store of value or as our money. And then about 3,500 years ago, we humans developed the ability to melt gold and use gold as money. And about that time, we started using gold coins too. And so gold coins, for the last 3,500 years, we used as money. And then about 500 years ago, the Medici family over in Italy started using what's called the ledger or double entry bookkeeping system. And that's what created the bond market and banks as we know it today. And so notes were, that's credit card. Notes were invented about 1,000 years ago in the 11th century by the Chinese. And so notes were the new technology 1,000 years ago. And what I mean by new technology is because we didn't have to carry around heavy bags of gold coins anymore, because paper money was the new technology, because it was lightweight and more portable, and it was more divisible too. And so, like I said, the Chinese invented paper money about 1,000 years ago. And then about 500 years ago, the Medici family in Italy invented the double entry bookkeeping system, or the ledger. And that's what the bank accounts and banking system and the bond market are based off of. And then all Bitcoin is the same double entry bookkeeping or ledger that we've been using for 500 years, but it adds a third dimension to it. And the third dimension is that we take a ledger and we distribute it around the world via the internet every 10 minutes. And so all Bitcoin is I look at it as triple entry bookkeeping, because we're taking the double entry bookkeeping we've been using for 500 years, distributing around the world every 10 minutes. So we're all using the same ledger. So we don't have to have the banks use their own ledger and then reconcile those. It's one universal ledger distributed around the world every 10 minutes. And so if we look at the history of money in a graphical form, like I said, for about 3,500 years, our money has been based off gold or hard assets like gold. And then what happened about 50 years ago in 1971, President Nixon took the United States off the gold standard. And then what followed after that is other major countries around the world went off the gold standard. And so for about 50 years, we have what's called fiat money. And fiat money is paper money backed by the trust in the government that issues the money. And as most of you know, trust in governments has been declining pretty substantially over the past 5, 10, 20 years. And as trust in the government declines, so does trust in the monetary system. And so we're to a point now where people are looking for alternatives. And the alternative in our viewpoint is that we're going to return to a hard money standard, and either a return to gold or return to like a Bitcoin, or go to a Bitcoin standard, which is actually a better version of gold. So Bitcoin was invented back in 2009 by a group or a person named Satoshi Nakamoto. But there was another group of people back in 1998 that tried to create Bitcoin. So Elon Musk, who's the richest person in the world today, who's the CEO of Tesla and SpaceX, Luke Nozick, and Peter Thiel, they all co-founded a company called PayPal back in 1998. PayPal's original mission was to create something like Bitcoin. They wanted to create a global currency that was independent from interference from corrupt cartels of banks and governments that were debasing their currencies. And so they tried for about a year to create this software, this open source internet protocol software that allowed them to do that, and they weren't able to figure that out. And so what they did was they changed PayPal's mission, and they started basing it off the US dollar. But like I said, originally they wanted to create a software packet, software program like Bitcoin. Back in 1999, Milton Friedman identified one of the problems with the internet was that there was no way for person A to transfer money to person B through the internet without having like a trusted third party. There was no way to do a peer-to-peer money transfer through the internet. And then back in the early 1990s, Mark Andreessen, who started Netscape. Mark went to University of Illinois. He was a couple of years younger than I was. when he graduated, he started Netscape using a piece of software that he developed called Mosaic. And Mosaic was the first internet browser. Well, with internet browsers back then, you needed, a way to do financial transactions. So for a long time, Netscape tried to figure out this open source internet protocol software to allow people to do financial transactions. They couldn't figure out how to do that either. And so what they did was they built Netscape, and the internet since then has built on basically credit card transactions, PayPal, and the legacy banking system. So, and the reason it was built that way is because no one could figure out how to create a piece of software that allowed us to move money through the internet peer-to-peer without double spending that money, without copying and pasting that money and spending it twice. And so that's all Bitcoin is. It's a piece of software that solved that double spend problem. So if we look at what Bitcoin is, like I said, it's open source internet protocol software. It solves that double spend problem, so you can't copy and paste and spend the same dollar twice. And the way it does that, it takes a ledger, and we've been using ledgers for 500 years. It takes a ledger, public ledger, and it distributes it around the world every 10 minutes. And what this enables is that peer-to-peer transfer of value through the internet that we couldn't solve over the past 20 and 30 years. And that's what Bitcoin does. It finally solves that problem. And so if we look at the internet protocol puzzle, Bitcoin's that final piece of the puzzle. So we all use internet protocol software every day, if you know it or you don't know it. Whenever you send an email, you're using what's called SMTP. That's Simple Mail Transfer Protocol. If you use the internet, you're using HTTP. That's Hypertext Transfer Protocol. These are open source internet protocol software that allows us to use the internet and send email. And so that's all Bitcoin is. It's another piece of open source internet protocol, but what this does, it allows us to send value through the internet. And if you think about that, most of the other open source internet protocol softwares like SMTP, HTTP, TCP, FTP, SSL, you couldn't own a piece of that. You can't buy stock in TCP or invest in TCP. But what you could do is you could buy domain names. Domain names have value. And the reason a domain name, or DNS, domain name system, the reason domain names have value is because they're a finite resource on the internet. There's only one Amazon.com. There's only one, eBay.com. And because of that, those websites, those domain names have value. And that's how you could think about Bitcoin. Bitcoin has value because there's a finite supply of Bitcoin. There's only 21 million Bitcoin. And today there's billions of people using the internet. So domain names have a lot more value than they had 30 years ago when there were only a couple hundred million people using the internet. And today, Bitcoin, there's about 200 million people using Bitcoin today. So Bitcoin's worth $37,000. But when there's billions of people using Bitcoin in a few years, Bitcoin's gonna be worth more because there's just more people using it. So when you look at how value is accumulated in blockchain versus the internet, back when the internet started, the application layer, and what I mean by that, the companies that built on top of the internet, like Amazon, Netflix, eBay, Google, those companies accumulated all the value except for the domain names. So the protocol layer, HTTP, TCP, DNS, those accumulated value, but it was basically domain names that accumulated value. But then all the companies that built on top of that accumulated 90% of the value, or probably 99% of the value. And then the protocol layer accumulated about 1% of the value. With blockchain, it's completely upside down. If you look at the protocol layer, if you look at Bitcoin, Ethereum, the 3,000 other protocols that are out there, Bitcoin or blockchain protocols, that's where most of the value is being accumulated. All those protocols are worth about $900 billion today. But when you look at the companies building on top of the protocols, like Coinbase, Kraken, Digital Currency Group, all those companies, if you add them up, they're worth about $100 billion. So most of the value is accumulating in the protocol layer. So that's something that's different than what happened with the internet. when you make investments in the space, in the blockchain space, it's our opinion that you want to look at the protocol layer. You want to look at the software layer, like Bitcoin. You don't want to invest in the company sitting on top of it. So why does Bitcoin have value? It's because of basic economics, supply and demand. So there's a finite supply of Bitcoin that will ever be created. That's 21 million Bitcoin. There's 18.6 million Bitcoin today that have been created. So 89% of the 21 million Bitcoin has been created. It gets created at a predetermined rate. When Bitcoin first started, it was created at a rate of 50 Bitcoin every 10 minutes. And then in 2012, that got cut in half to 25 Bitcoin every 10 minutes. And then in 2016, it got cut in half again to 12.5 Bitcoin every 10 minutes. And then in May of 2020, it got cut in half again to 6.25 Bitcoin every 10 minutes. So there's about 900 Bitcoin a day being generated. The software says every 210,000 blocks, and a block is about 10 minutes. So 210,000 times 10 minutes comes out to about 4 years. So approximately every 4 years, the amount of new Bitcoin that gets created and rewarded or paid out to the people clearing the transactions on the Bitcoin blockchain, that reward gets cut in half. And so it keeps cut in half again in 2024 and then 2028. And in 2028, 99% of all the Bitcoin that can be created would have been created. And then it's going to take about 100 years to create that last 1%. So that's the supply. It's fixed, it's predetermined, and it can never change. So what about the demand? If you look at the demand for Bitcoin based on blockchain wallet addresses, the number of blockchain wallet addresses has been growing at a rate of 300% a year since 2012. And so if you have rapid growth of demand at 300% a year, and you have a finite supply of a scarce asset like Bitcoin, the only other variable that could change is the price. And that's what's happening. The price is going up because demand is going up. And so Bitcoin goes through cycles. And if you look at when Bitcoin has a halving, that's when the new supply gets cut in half. The 12 to 18 months after that is the best time to own Bitcoin. So if you look after the 2012 halving, the purple column, and after the 2016 halving, the third purple column, and then after the May of 2020 halving, the very last one, you can see that's where Bitcoin did the best. And it's intuitive, right? If you have half as much Bitcoin being rewarded or coming as a supply to the market, and you have the same amount of demand or even more demand, then the price goes up. And so, like I said, the 12 to 18 months after a Bitcoin halving, those are the best periods to own Bitcoin. So Bitcoin's also been the best performing asset class 10 out of the past 12 years. And so if we look at Bitcoin as an asset class compared to small cap stocks, emerging markets, large cap stocks, REITs, high yield bonds, like I said, Bitcoin's been the best performing asset class. The numbers underneath the year, like for example, this year it says 3x, last year it says 17x. That's the multiple Bitcoin did better than the next performing asset class. So for example, in 2020, Bitcoin was up 308%. Small cap stocks were up 18%. So Bitcoin did 17 times better the next best performing asset class. And so when Bitcoin does better, it's not doing like 3% better or 5% better. It's doing like 300% better or 3,300% better. It's not just a little bit better, it's multiple times better. If we look at how Bitcoin is spread out among age groups, so this is data that came from Charles Schwab about a year ago. And Charles Schwab divided out their top 10 holdings by age groups. So they have millennials, Gen X, and baby boomers. So millennials, the 5th largest holding for millennials at Schwab about a year ago was Bitcoin. It was the Grayscale Bitcoin Trust, GBTC. And why this is important is that there's going to be $68 trillion of wealth that's going to be transferred from the older generations down to the younger generations over the next 25 years. And as these younger people, younger generation, as they receive this inheritance or this, generational wealth, a good chunk of that's going to be, invested in Bitcoin and digital currencies. And so there's this huge tailwind of money that's going to go into crypto assets or blockchain digital assets over the next 25 years, because that's what millennials are used to. They're used to investing their money in digital goods. And so where are we on the adoption path of Bitcoin? What S-curve analysis is the way to measure the adoption rate of new technologies. And so what this shows is that the amount of time it takes for a new technology to go from 0% adoption to 10% adoption is the same amount of time it takes for that technology to go from 10% adoption to 90% adoption. And so based on S-curve analysis, between 2009 and 2010, in 2010, 10% of households own Bitcoin and digital assets in 2010. Last year in 2020, it was 15%. Okay. What this means is that in 2029, it's very likely that 90% of US households will own Bitcoin or have some sort of digital wallet address. So that's the adoption path that we're on. Between 2009 and 2010, it was basically too early to invest. We're in the sweet spot now where it's a good time to invest because we're on this rapid adoption path going from 10% to 90%. But then after 2029, it's going to be too late. So why do you add Bitcoin to a diversified portfolio? Well, let's look at what the Federal Reserve says. This is the Federal Reserve Bank in St. Louis. They put out a white paper in January 2019 about cryptocurrencies. And what the Federal Reserve says is that Bitcoin will emerge as its own asset class and thus have the potential to develop into an interesting investment and diversification instrument. The reason they said that is because Bitcoin is a non-correlated asset. And what I mean by that, I don't mean it's negatively correlated. A negatively correlated asset means if stocks go up, Bitcoin goes down. Or if stocks go down, Bitcoin goes up. That's a negative correlation. A non-correlated asset means Bitcoin moves with no rhyme or reason with other asset classes. And when you add a non-correlated asset to a diversified investment portfolio, it actually reduces the risk. No matter how volatile that investment is, because it's non-correlated, it reduces volatility. And so what I want to show you is this screen. So if we take a portfolio that's 60% in stocks, 40% in bonds, that portfolio averaged about 7.7% over the past 5 years. The volatility was 7.96, and the maximum that portfolio went down was 21.6% over the last 5 years. If you add 2% of that portfolio to Bitcoin, so you have 58% stocks, 40% bonds, 2% Bitcoin, the returns go up dramatically from 7.7% to 10% a year. The volatility barely changes from 7.96 to 8.08, but look at the maximum downside. The maximum downside for this portfolio was 21.51%. So adding 2% of your money to Bitcoin actually cushioned the portfolio on the downside during the downturns. And so that's why fiduciaries, asset managers, high net worth families, they're adding Bitcoin to the portfolio, is because it's a way to cushion your portfolio in down periods. Now, here are our models talking about Bitcoin's projected value. These aren't guaranteed. These are just projections. So don't take these to the bank and don't come back and say we were totally wrong. So these are the 4 models that we use that we believe are the best models to use. So this is just our most simplistic model. All it is the historical price of Bitcoin on a logarithmic scale with a linear regression line run through the center. And so this model has an 87% correlation to the historical price of Bitcoin. And what it shows is the end of 2020, Bitcoin should have been worth like $30,700, which was kind of in line what it was worth. But Bitcoin could be 90% above this line or 90% below it. So right now, Bitcoin's pretty much fairly valued based on this model. Another model that we use is based off Metcalfes Law. And like we talked about earlier, Bitcoin's a network. And if you value Bitcoin as a network, that's what you use Metcalfes Law for. So you square the number of users and you multiply that times the transactional rate going through the transactional volume going through the network. So between 2014 and December 2017, there was a 94% correlation between this model and the price of Bitcoin. What happened in December 2017 was that the US government allowed people to short Bitcoin for the first time. That shorting, that short pressure has put basically someone stepping on the price of Bitcoin because of the shorts that are out there. Our model, we believe, is very accurate. We believe that Bitcoin's fair market price today should be $106,000 per Bitcoin. And because of the short pressure that's out there, that's actually trading for this model, or this screen says 35, but it was, this was last updated about 2 weeks ago. So today the price of Bitcoin is 37,000. So we believe that this model is correct. The fair market price is 106 today and it's trading for 37. Once the shorts start closing out their positions, we believe that the Bitcoin price will go up and reach that 106,000. Another model that we use is based off of what's called a stock to flow model. So there's a person out there that's called Plan B, follow him on Twitter. This is his model that he uses. This model is 95% correlated to the price of Bitcoin. And since time's running short, I might not explain how this model works. You could read up on that. But basically what this model shows is that Bitcoin should be worth $100,000 later this year, $1 million in 2025, and $10 million of Bitcoin in 2029. And then another way to use the stock to flow model is take dollars out altogether and just use gold as the monetary unit. And so when we first started using this model about 2 years ago, this model showed that Bitcoin, it took 4 ounces of gold to buy 1 Bitcoin. Back in 2012, it took 1/10 of an ounce of gold to buy 1 Bitcoin. Today, it takes about 22 ounces of gold to buy 1 Bitcoin. And what this model shows is later on this year, it's going to take 100 ounces of gold to buy 1 Bitcoin. And in 2025, it's going to take about 1,000 ounces of gold to buy 1 Bitcoin. So not only is Bitcoin becoming more valuable in terms of dollars, it's becoming more valuable in terms of gold too. And so this is our most accurate model. This model is 99% correlated to the historical price of Bitcoin. And so, if gold is at $1,500 a year from now, what this model basically says is that 100 ounces times 1,500 is $150,000. So why add Bitcoin to a portfolio? Well, like we talked about, it increases your risk-adjusted returns or increases your Sharpe ratio. It's the next new mega trend based on S-curve analysis. It increases your portfolio performance. It's a completely misunderstood asset class. Only 15% of US households own Bitcoin today. What that means is that 85% of the US households don't understand what this is. If you take the time to learn about it, spend 10 hours, learn about it, understand what this is, and then you'll be one of the informed ones and it won't be a misunderstood asset class to you anymore. And then it's also protection against economic uncertainty as we transition from a fiat-based system to a new monetary system back on hard money like gold or Bitcoin. And so how do you get access to Bitcoin? You can do it through Coinbase, River.com, Robinhood offers Bitcoin. The Grayscale Bitcoin Trust is a good way of doing it. If you trade through Schwab, Fidelity, TD Ameritrade, there's several other firms that offer GBTC. Just a warning though, GBTC is a closed-end trust and it trades at a premium above what the Bitcoin's worth. So if you don't know what that means, ask your financial advisor or look it up, figure out what that means. And then you could also buy Bitcoin at PayPal too. You can buy up to $20,000 per week of Bitcoin at PayPal. And so that's the end. If you have any questions, we offer consulting. So our fund is closed, Off the Chain is closed to new investors, but we do have an institutional consulting arm where we help people gain access and teach them about Bitcoin. Like I said, it's for institutional investors. It's a $250,000 a year subscription model to subscribe to our consulting services. But we are here to help. So if you have questions, you can email consulting@offthechain.capital.
Ryan, thank you very much for your presentation today. And
I went 3 minutes over, so sorry.
That's okay. We started you late. David and Brian will give you guys extra time. So please take an extra 5 minutes with your presentation. Ryan, thank you for being a sustaining member of Fiat. Thank you for sponsoring this event. It was a very educational presentation today and the exact type of content that we love here at Fiat. So thank you for that.
Thank you. I appreciate it.